We continued our bounce from Friday up through today. A lot of those technical signs we talked about that ended so well. The week might have not have gone well, but we ended Friday so well. That technical bias carried itself through, even with a little bit of a gap down today. So I'm going to break down now that we got this bullish day today. Is this a sign of what's to come for the rest of the week, or is this kind of a failed move, kind of a faux bounce, so to speak? So I'm going to break down the technicals, breaking down what's leading during this bounce, this 2-day bounce. What's really kind of leading us higher? Does that tell us anything about risk appetite levels? And then finally, one leader stock that had a great day today. We'll take a look at that for a trade idea. So let's go ahead and get started. Today is Monday, March the 5th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Thank you, as always, day in and day out for watching. Welcome to those that have found us for the first time. Glad to have you. Keep coming back. Subscribe to our YouTube channel by clicking that red subscribe button right down below. You can do that right now while you're watching. Also, while you're down there, hit that thumbs up icon. That lets me know two things. Number one, it lets me know you got something out of it, that you liked the video. And number two, it tells me, hey, David, do it again tomorrow. So one-click way to give me feedback there. Comment on anything that stands out to you from today's video. Love to see what you're learning. Scroll down further. You can comment down there below. Also, join my daily email list where I send out a summary of what we talk about in these videos, time-stamped hyperlink summary. So make sure that you get that email by clicking the link that I've highlighted here in the description below. Follow me on Twitter for more content in addition to these videos. You see my handle on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Join the Market Outlook community on Facebook. Again, there's the address there at the top. There's also a link that I've highlighted down below that will take you there. All right, well, let's take a look at the market forecast indicator on the S&P 500. You notice we pretty much have reversed the drop that we had starting on Thursday after gapping back up to 2725-ish, 2730. And then falling back down and having that bad day where we finished all the way down to 2650 at the low of the next day. So pretty decent move, almost 100 points, about 70-point move off of yesterday's low point. Friday's low point up to today's close. Obviously closing above the high of the low day there. A nice, good bullish reversal candlestick pattern. Brought the near term and the momentum lines back up, continue to bring them back up. They were already coming up. You can see again the near term line hitting a low point. These consecutive low points here where obviously one was much lower. Getting above or working its way toward getting above that old low point. The old near-term low, which should act as a resistance, right? When you have higher highs and higher lows, lower highs, lower lows, those lows should act as a resistance on the way back up. We kind of busted right on through that. That was at 2,700. When we crossed through 2,700 today, it kind of took off. And then, of course, the high point in between these two lows would be back up to last week's high point. So bullish move. We talked about the bullish close we had on Friday, and that led into today's move, even with a little bit of a gap to the downside with some weakness in the futures overnight. It's a reminder not to put a lot of stock into overnight futures action because the volume is just so low. And now, it can stick around, but don't assume because futures are down in the evenings that it's going to be down by the next morning. You still have the European close. You still have the the European Open around midnight or so, 1 a.m. And you have you also have the Europe, UK, and then you also have the U.S. Open the next morning at 8 a.m. Eastern. Where you can get economic data throughout that and earnings announcements throughout that morning. So that can really impact what futures may be doing the previous evening, at the Asian Open. And Asia usually just reacts to what's going on in the U.S. So a lot of that can spill over into that Asian Open and kind of give us a false sense of what can happen the next morning. Good or bad, right? One way or the other. You can see, again, the intermediate line still dropping, but it's still above 50. And just like, over here, when it's dropping above 50, it doesn't change the posture until it gets back below 50. Again, if we have a good strong move above 275 tomorrow or 2750 tomorrow, pretty good chance the intermediate line just turns right back up and stays up and continues higher. And you can see the market sentiment line also continues to fall, now falling to a low that we had that eventually bottomed out. Now we had Brexit here, but that low point eventually bottomed out right in this area on market sentiment. You can see there's the two intermediate low points corresponding to those. So this intermediate low point here was protracted enough that eventually is what produced the market sentiment low point. You can see we bounced off of that for a few months before getting a new intermediate low, and then that continued higher. So this move here off that intermediate low and through another one was pretty much what happened with that market sentiment low point. And then of course this stronger, and you can see the intermediate lines, how different they are when the intermediate line gets below 50, and see what it takes to produce a market sentiment line drop. And of course, neither one of these even got below 50. So we haven't had a drop on the market sentiment line below 50 since the election, since that November 2016 election right here. So that was the last major market sentiment low, and you can see the move it's had, so far up till now, even still off that same low point. All right, so take a look at the other indexes. You can see there's your, remember how the Dow didn't bounce up as much on Friday at the end of the day, and continuing high today, getting that Morningstar candlestick pattern there. Still kind of trading at the low point, so a little bit under 25K. That's a big number for the Dow, and its intermediate line did drop below 50. So bearish intermediate high point here for the Dow Jones Industrial Average, a lower high that corresponds to a peak on the intermediate line between 50 and 80. So not a really good sign there. The fact that, again, we'll have to see if this market sentiment line, if we fail to get this near-term and momentum line, or at least the near-term line, into the upper reversal zone and reverse that trend, then that can be a bearish sign for stocks, getting a bearish high point like that. And we just, like I said, haven't seen that yet on the S&P, and of course not on the NASDAQ, not even close on the NASDAQ, which is why you wonder a little bit about the Dow if we'll get a real bearish move, because, look at the NASDAQ. That's a strong bullish close, closing above the highs of the past couple of days there, and getting a lot closer to its last week's high, or the previous week's high, than the S&P even is. So it continues to show some leadership, the technology sector, and its near-term line again. And not only is its intermediate line a lot higher, still pulling down, but a lot higher, not close to crossing below 50. Its near-term line is also a lot closer to getting into that reversal zone and confirming this kind of bullish bounce that we're getting. Russell 2000 already did get the Morningstar candlestick pattern yesterday, on Friday, closing above the last few days' highs, and of course, just like the NASDAQ, getting close to its previous peaks there. So good sign in its near-term line. Its intermediate line is closer to 50, but hasn't crossed below it yet. Still dropping, and its near-term line is back in the reversal zone. Now, it's done this before when we kind of peaked our way up and then broke down. So, we're gonna, last time it got above 1550, it was more of a failed breakout, and we'll see if another cross up above that is able to sustain it. A lot of times you get those sustained breakouts, but you also notice, again, that was a failed breakdown to the downside as of right now on both the Russell 2000, remember the S&P as well, and especially on the NASDAQ, where the 7300 was a breakout move. We got up above it, came back down, now we're right back there again, right about that 7330 level. A really quick reminder for those watching and follow me on Twitter. We noticed we got to 100 likes here. That's kind of like our break-even point to let us know to keep doing these videos on YouTube. And so the more we get the likes and the retweets, the more we know, that's what you want us to do. This is our way, or your way of telling us, hey, we liked it today, we got some value out of it. Do it again tomorrow. And again, to do that, it's really one-click easy thing to do. You can do it while you're watching. Just go to Twitter. There's actually a link in the description down below that will take you straight there, actually, to this tweet itself. And then just click that like and or retweet button. Either one or both. The more you do that, the more it benefits you, because Twitter keeps pushing you my stuff. The more it benefits me, because it pushes it out to all now almost 5,000 followers, and I haven't done anything on Twitter to get to that number in terms of like ads or anything. So thank you very much for all of you who follow me. And again, for those who aren't Twitter people and you wonder why would anybody use that, is to get stuff like this out there to you, and not just this video, but other little bits and pieces of content or other good articles that are relevant to what we talk about day after day in these videos. All right. That being said, we'll take a look at the long-term chart here. Hey, look, another arrow. Boy, haven't we not talked about that before? That we're going to get arrows. That we're going to get up. You know, as we have this big gap, which has been unprecedented, both on a relative and absolute basis. As we get that large gap and we start to come down a little bit, we're going to get We're going to get more arrows, and you know it's coming down now. It won't go straight down. You can see, you know, when we peaked here at the beginning of 2014, we went up and down and back up, and down and back up, and down and back up, and down and back up. And now, granted, this is over weeks, so again, that's kind of the expectation here is, you know, we had a move where we didn't get very many arrows like we saw in 2013. Now in 2014 and beginning of 2015, we're in that mode where we're still in an upward trend. The 50 is still above the 200-day moving average, but we're going to get some more ups and downs. It's going to be some more volatility. We might be more towards this end than we say over here. So that's what we have going on right now. You know, it's only one day, but we're already got the green arrow back today. And of course, looking at the 3 green arrows here, the MACD is back up above its moving average. You can see the arrow on the green arrow there. We're back above both the 8 and the 17-day moving averages. The 8's got to get above the 17 to get the black line down here above 0, which is expected as long as you're above the moving average. Stochastics is down a little bit, but so is that intermediate line, right? So as long as it doesn't drop below 50, and if it forms a phantom green arrow here, all the better. When you look at the intraday move, you can see it's been quite the move. Again, off that low point, almost an 8-point move there. But, you know, again, you have to put this in the context. And just like we said on Friday, you know, we're still in the upper half of the 4-week range. We got about a little bit below the midpoint of this 4-week range, which you can see now the high's right there. So that's not going to come down anytime soon. You know, in another week, we'll move up to low point. And you can see we'll move it up pretty dramatically up to, because it was such a sharp move there off that low. We'll move up to low point for the 4-week range to about right there, and then in this area, and then eventually to 265. So you know, so you notice that we stayed in the top half of the range. We're about to when you're in the top half of the range, you're more bullish than you are bearish. And then that's going to change pretty quickly here to about a 14-point range, which is still pretty big. The halfway point between that's going to be around 272, which we're above, a little bit above right now. So if we get above this 273 level, we'll be in the top half of the range for, you know, what will be the new range, if not starting to push that high up a little bit higher if we start approaching 279 a little bit earlier. So again, context in these moves. You know, you can get ups and downs moves in the top half of these ranges, especially when they're as wide as they are, and just be fine. Just be fine, and that's what we're seeing here. Obviously, a higher high and a higher low today, much higher high and a much higher low point. And closing, you know, a low day was early, the high of the day was late, so positive in that regard. You know, we got a long ways to go to get to last week's high point, so that's way up there. So we got about another 7 points or so if we were to keep going up, barring any unexpected news, right? Otherwise, we wouldn't have moved up this much if the market was expecting some news. So that's what the today's candle, you can see, is a nice, good range, 5.25 points, bigger range than what we saw Friday, and a little bit less than what we've been seeing over here, at least on Thursday when we had the big downward break below 270 when things really accelerated there. So back up above that, kind of reversing that breakout to the downside. Look at the volume, 96 million. So not a lot of volume on this upside. And remember, the bullish moves don't get a lot of volume, and we already saw that there wasn't as much volume on Friday either. It's below average. So 97 million. And then the range was above here. You want that range to start coming down over the next few days to get to the 3 to 4 point range at least. But the volume already has come down. Remember, when these lines go down, it's bullish. So the fact that volume was at 96 million, and that if that keeps pulling this line down, that's a good thing. When we've seen this come down in the past from these higher levels, eventually you'll see. Let me get back. We just have never had a big peak on the volume for multiple years. Might even have to go back even further here. There we go. So when you can see when we pull down from both these from high levels, it's bullish for the markets. You can see some other peaks here on these, and then as we pull down, so we start off the low point when they're at these high levels, so you get some bigger moves, and then we really slow down as we continue to move higher. Here's another one. There's the election. You can see how small those peaks were and how we continued higher while those lines came gradually lower. So we've got a lot lower to go here, as we bounce off of these low points. Finally, the volatility index, we dropped from 25. We continue to drop. We had closed below 20 on Friday. We started back up above 20, continued down. You notice we didn't go down any further the rest of the day. While the market was going up, we dropped down right at the beginning, and then it kind of stayed in this level. So, 1750, a little bit of a break there, but 1750 is going to be an important level for us to break down. And again, look for lows in this 12 to 15 area, because again, we probably won't get volatility back into the single digits again with a new kind of era of higher volatility that we'll be in for most likely the rest of this year. Now, what you will see is a drop in volatility, if not on the absolute basis, to those single digit levels. You will see this drop. This can drop back down to extreme lows here, but not down to single digits. We've hit 80% or lower with the volatility index higher than 9 or 10. So when we see this start to drop back down, that's when we know it's gone. The VIX has gone down too much, no matter where it's at on the absolute basis. So you notice we're not close to being extremely low. In fact, we're still bearish. The volatility is still higher. It's still got room to continue to drop down while the index itself pushes up higher into this trading range, this 4-week trading range, just towards the highs of that 4-week range. All right, when we take a look at what's driving the price action today, you can see ISM manufacturing and non-manufacturing, the services index, was really high and continues to be really strong. So the services sector is looking pretty well. That's on the ISM. The PMI is the other version. You can see it met expectations with a higher number too. Pretty decent numbers from the services side of things. That was really the only thing. That wasn't obviously what drove the price action. What's driving the price action is this idea that this is the rate hike odds for December. If I were to come over here to the actual calendar, you can see you still got about a 30 some odd % odds, which is a little bit lower than what it had been a couple of days ago. About the same as what it was on Friday. And the odds are still about 30 some odd % there. And you can see up from where we were a month ago and even a week ago. It was last week that things Wednesday and Thursday, things really hit the fan on those rate hike odds, pulling back down a little bit on Friday and then today. So, but still about 40% odds of 3 rate hikes or more, 40% plus these. So we're looking at 70% odd, pretty high probability that we'll get 3 rate hikes by December. The question is 4, right? So we're at 30% now. If you take a look at the historical here, again, you can see that there's your 3, and we're up above 40%. There is only having 2, and that line's been dropping as this line has been rising, and they're kind of neck and neck right now. So as that dark blue, which would be the 4th rate hike, continues to rise, we've seen the market get a little pressured from that. If it were to start to pull back a little bit like it did at the beginning of February here, drop back there because of some weakness in the markets. But we've seen that, if it were to pull back, that would provide a little bit of a boost as long as, the rest of these don't pull back. And, like this gray line, see it pulled back too. And the red line's the one that rallied, the one that we wouldn't get any rate hikes at all. So in fact, look, 6 months ago, we were at 125 basis points. Remember, we're at 175 right now. We're at 150 right now. we're at 125 right now. 6 months ago, at the beginning of September, and take a look at the economic surprise index here, early on in September, we're still very negative, coming up off of an extreme low point. The odds of getting any rate hikes at all for this whole calendar year was the highest. There was your 1, there was 2, they were kind of, 20 to 30%. So you had pretty decent odds you'd get 1. You had what, 60% odds you get at least 1, but they weren't very high. The market didn't really know, and the market had higher odds that we wouldn't get any. So 6 months later, now we're getting them. Right now we're expected to get at least 1 in March. That's pretty high. That's baked into the cake here. There's the March odds. That's baked into the cake to get that 150. It's up above 80%. There's not getting 1, which again in September, the odds of not getting 1 at all were pretty high. Then now you can see in June, the odds of getting 2 have really bumped up and held up. So, it's continuing to look like we're going to get 2 by the middle of this year. The second half of this year, that's the question mark, or whether we'll get 1 or 2 by December. If you take a look at how things have been performing here over the last couple of days, again, off that intraday low point, and you can see crude oil has been a big driver of this bounce. And we talked about that in the previous videos, that crude oil had bounced up off of those Bollinger Bands. Let's go back to a 1-year chart. Breaking back up through there and moving back. You can see a good bullish move high today off that low point on Friday. So long lower shadows, good bullish pattern for crude oil. Taking a look at the dollar index. Whoops. Keep wanting to put the futures contract in there. You can see the dollar index kind of holding up, pulling back a little bit down. You can see on the ETF, had some strength early today, very minimal. By the end of the day, lost a lot of that. But at least that pressured gold. And you can also see, again, long-term bonds falling. So yields rallying a little bit on the 10-year note. And you notice that did not put any pressure whatsoever on stocks. So another positive sign for risk appetite, regardless of the fact that U.S. stocks are leading, number 1. And number 2, as despite the tariff news and everything that could be impacting us, right, U.S. stocks are leading, and small cap stocks are leading large caps. Emerging markets are still leading develops despite their relative underperformance. So good signs here, and you can see high yield outpacing treasuries, making a good move up. So good signs for risk appetite as a whole, especially with crude oil and small cap stocks leading the way higher. What's also interesting in this balance is it's been more broad-based. Again, we saw Friday how utilities kind of lagged behind, but real estate made its way up, and consumer staples, which have been, all those have been lagging with interest rate moves. You can see there, all 3 of those sectors are up at least 1.5% during this 2-day climb. So, of course, financials leading the way higher. You can see technology continuing to be a trend. Not surprising that energy stocks are leading too. And if I were just to look at including the bounce, look at utilities and real estate today taking off right off the bat. And then, of course, once everything else started to take off, they slowed down a little bit. But still, utilities up 2% today. Real estate matching the market gains, giving back some of its relative performance. Financials taking off with this move higher. Technology matching the market. Energy matching the market. And there's your staples. So just barely underperforming. So broad-based move, which again tells you that the markets are relatively bullish. That's a broad, good bullish sign for risk appetite. One stock that kind of led this rebound and really didn't have much of a pullback during this recent decline was Boeing. You can see this recent decline did produce a couple high volume days that pushed us down to 3. That's how far up we were. Pushed us down to 3 red arrows. But as is the case typically on upward trending stocks, when you get 3 red arrows, what we teach is that's when you're riding a trend. that's the day that you move your stop order up to below that, whether it's 3% below that, whether it's 2 ATR, 1 ATRs, whatever the case is. Give yourself some room to work with below that support level, but that would be your signal to move up support. And you can see today getting an engulfing pattern back to 3 green arrows with above average volume. So pretty decent move and getting back up above 350. The low point of that, and you can also see too on the after closing below the lower exponential moving average, back up above that middle exponential moving average. So another positive sign. This line I've got drawn there actually you can see it's right at that lows of these past couple of days, that $340 strike price. So that's the idea. It's like, okay, what if we were to hold those lows, put a stop order below, or sell that strike price below that at 340, then we can say, okay, you know what? Buy the 335 for protection. So I get $1.24 out of that. $1.16 on a $5 wide spread gives us a 30% return on risk, and it puts this kind of get out of Dodge level, which right now gives us a $100 loss versus a $124 gain, puts it down to about 338, 337. So it would kind of make sure that, okay, if we don't hold these lows, then we can get out of this trade and move on to something else. And knowing that a nice good bullish engulfing pattern today can help us stay above that price. So that's kind of what we keep our eyes on. Also, the nice benefit too of how bullish this is we've got for us to get to a $128 loss following the purple line. It would take look again, or $124 loss, excuse me. That's how much move it would have to continue to drop down to 333 to get to a 1-to-1 reward to risk ratio. So the fact that it's not a 1-to-1 at that crossover point buys us up time. Now remember, as time passes, that line's going to drop. So it will take less to get to 124 because as time passes, the purple line drops to the green line. But you can see it takes a while for that line to really start to decline to that angle, that sharp angle you see there. In fact, you pretty much have to get right on expiration for it to steepen up that angle there. So again, it's a high probability trade. The market's trying to turn bullish. Remember, the posture's still bearish, hasn't crossed below 50 yet, so we don't want to be too aggressively bullish here. But when we find opportunities from leaders with good candlestick pattern or good technical patterns, candlesticks, as well as other oscillators and things working in our favor, and you can see here from the 2-line version, they're all still up above it, and we're almost right back up above that 8-day moving average with decent volume, with the MACD itself still above 0. With the potential rising. So, if we were to bounce off of this with another run similar to what we had here at the beginning of February, then that would give us an opportunity to profit from that short put that we sold at 340 using the 335, the long put, as any kind of protective move if we were to sharply move to the downside, maxing out any loss at a certain level that we can position size around. Even though we'd like to take less than that, we at least position size around the possibility of a maximum loss, because news can come out at any time on any stock and really push it down. So that's why we buy that put for protection, to reduce the cost, the margin, to get into trade number 1, and number 2, just protect us from any worst case scenario. So with that, thank you very much for watching tonight. As always, thank you for tuning in day in and day out to these Market Outlook videos. Remember, for those of you who filled out our market research survey, would have been a few months ago on that, make sure that you check your email. We wanted to send something out to you tonight. Again, for those that filled out kind of a follow-up to that survey we filled out, months ago, and there was about 1,000 of you. So make sure you check your email tonight for something that we wanted to send out to you. And that being said, as always, thank you. Have a great evening, everybody. Remember to like, subscribe, and comment down below in the YouTube channel. Follow me on Twitter for more content like this, just in bite-sized written form. And you'll see the link to do that down below in the description. Also, join the Market Outlook community on Facebook, over 900 strong. So join, be one of those and join us there. Have a great one, everybody. Again, we'll see you all tomorrow.